The world is heading into a recession. That's what literally many of the indicators are saying today. But recessions are the world's greatest opportunity for you to make money. Fortunately, it's not my first one. In 2008 recession, you could see some people who did amazing and some who didn't. In this video, I'll share with you my exact plan for how I'm going to play this upcoming recession. Why is there a high odds of a recession? A recession is defined as an economic decline for 2 quarters in a row. It is often characterized by a decrease in GDP, leading to lower consumer spending, a higher unemployment rate, and less business investment. It will reveal a slowdown in economic activity and often goes hand in hand with casualties in the stock market. JP Morgan increased the odds of a recession in 2024 to 35% in its most recent economic forecast. And the Sum Rule recession indicator, which is an indicator that signals the start of a recession, when the 3-month moving average of the national unemployment rate rises to 0.50 percentage points or more relative to its lowest point in the previous 12 months, did just that. It broke the 0.50 threshold. The Federal Reserve has kept borrowing costs at a 23-year peak of 5.25% to 5.50% for over a year, which is an early sign of a recession. The unemployment rate recently increased to 4.3%, slowing that the labor market is weakening. Signs are there. Job growth just dipped from 179,000 in June to 114,000 last month. The point is clear. All indicators are currently looking at letting you see early signs of a recession. And what the geopolitical tensions that are currently going on from Israel to Ukraine, a recession in the U.S. almost seems imminent. Why the Chinese markets can save you, while the U.S. is heading toward a recession, and the stock market is already revealing clear signs with the NASDAQ having one of its worst days in recent years. The Chinese market is revealing a completely opposite sign. The Chinese market can be another way for when the U.S. is in shambles and stocks in China are currently massively undervalued. When the U.S. economy is declining, the Chinese economy is building rapidly. In Q1 of 2024, it built by 5.3% year over year, with expectations of an additional building up more than 4.6% for the remainder of the year. And it's not just the overall economy that's doing great. Individual Chinese companies are also starting to outperform U.S. companies across all metrics. BYD, which is a Chinese electric manufacturer, just surpassed Tesla in monthly sales. And it is now the leader of the global EV market. And that's just one example of how Chinese companies are outpacing American companies. If the economy and individual companies that are doing good right now isn't enough for the stock market to thrive, the Chinese government is now expected to implement further monetary policy measures, such as interest rate cuts, with the goal of stimulating the economy. The government also plans to invest all these retirement funds in its own stock market. And if you're worried about the U.S. stock market pulling other stock markets into a downturn along with them, you don't have to be worried about that when it comes to the Chinese stock market. It is certainly a valid concern, though, because it does happen for a lot of other markets, such as the European markets. It even used to happen for the Chinese markets. But the Chinese stocks have recently started showing signs of decoupling from the U.S. market. This could actually make the Chinese stock market into a hedge against the U.S. recession. And not only do I expect Chinese stocks to perform great or good, some of them also offer dividends of up to 20% per year. which is certainly a nice bonus if you pick the right ones. I think the Chinese stock market is the biggest opportunity right now, at least one of them, because it does not seem to be anywhere near a recession, whereas the US is clearly there. The risks, but of course, it's not completely without risks. First of all, because China clearly has some political tensions, they have the potential to massively impact their economy. The relationship between China and the United States basically consists of tensions, including trade wars and human rights issues. This could lead to sanctions and even impact market access to investors worldwide. If these tensions play out the wrong way, this could certainly have a negative impact on the performance of Chinese stocks. But there is also the regulatory environment to think about. The Chinese government keeps quite strict control over its economy and occasionally imposes sudden regulatory switch-ups. Foreign investors face restrictions when trading, and the government could switch regulations whenever they want with little notice. This strict regulatory control is because the Chinese stock market is emerging and upcoming market, right? And with emerging markets, you often have, some of these other risks. China is subject to higher volatility compared to developed markets. Volatility is just something that's inherent to emerging markets. Factors such as economic policy switch-ups and political events could lead to quick shakes in stock prices. Emerging markets also often have a lack of transparency because there's little financial reporting and data. So it's a challenge for investors to access the true financial health of companies, which makes it more of a challenge to make more informed decisions. How to win in 2024 recession. But despite these risks, I still think the Chinese market is the way to go if you want to win in the 2024 recession. It's what some people are using to replicate their success maybe from the 2008 financial crisis. And if you want to do the same, here is a 4-step process I would recommend you take. It could help. Step 1, research, research, research. If you actually want to use the Chinese stock market as a hedge against the 2024 recession in the US, you need to understand every single detail that makes China unique than the US. Start by researching the fundamental uniqueness between the Chinese and the US stock market. Understand that the Chinese stock market hasn't been around as long and has historically been dominated by retail investors, which could lead to higher volatility. Read books, look at YouTube videos, talk on forums, do everything you could to learn about the Chinese market. Keep a close eye on China's GDP growth projections and economic indicators. Despite global challenges, China's GDP is expected to continue its upward trajectory. And this thesis is built on that. So you need to know if those key foundations stay the same. You don't have to do it all yourself. While I would always recommend you to do your own research and to only invest in things you actually believe in, it's fine to look to experts to learn more. Someone else's insights could often bring you valuable context you didn't think of yourself. Step 2, find competitive advantages. If you want to outperform the US markets, you have to find places where the Chinese companies or industries have genuine competitive edges of their US counterparts. Electric vehicles and technology are 2 examples of them. To find these, you need to do even greater research, more research rather. Start by doing an analysis of sectors where Chinese companies are known to be good. Industries like electric vehicles with BYD and phones with Huawei. Find out everything you could about those industries, because this is where you will find huge opportunities of the decade, the biggest ones potentially. Compare metrics of Chinese companies with their US alternatives. Look at production, efficiency, cost structures, market penetration, and R&D investments. If BYD metrics are genuinely better than Tesla across the board, the odds that the stock will pick up on that at some point in the near future are so high that the risk reward is exceptional. It's important to also keep general market trends in mind. AI is obviously a big and important market right now, and will most likely continue to be over the next decade. I can almost guarantee you that multiple AI unicorns and potentially even an OpenAI competitor will come from China over the next few years. The Chinese government is investing $91 billion into AI this year alone. It's your job, find these future unicorns. Step 3, be cautious. And you won't be able to get there without taking any risks. Investing is risky after all, but you still need to be cautious when you're doing it. Don't take unnecessary risks. That's why you should always avoid decisions that are purely driven by hype. Never invest in something because your barber or taxi driver is telling you to do it. Once those people are recommending it to you, you can guarantee it's the next hype bubble. And obviously hype isn't necessarily bad. Nvidia is massively hyped right now. And that certainly played a part in the incredible returns it has given over the last few years, 3 years. But that doesn't mean Nvidia isn't actually a great company that will shape the future of how we use AI, because it is. It's up to you to decide what level of hype fits your investment goals or risk tolerance. Even if the company is amazing, the hype around it will die down soon, or will come down soon rather. But you need to be prepared for that. The best way to be prepared is to take your due diligence very seriously. With any company you consider investing in, take a moment to research and analyze everything there is to know about it. Warren Buffett spends months researching a company before he even invests a single dollar in it.
Since we were talking about railroads, I went through the Moody's Transportation Manual a couple of times. That was 1,500 or 2,000 pages, or probably 1,500 pages. And I found all kinds of interesting things when I was 20 or 21. And actually, that's what impressed Charlie when I first met him, because I knew all the details of all these little companies on the West Coast that he thought I would never have heard of. But he thought he was the only one that knew about that. And that became an instant point of connection. So I would try and know everything about everything small, and I would find something. And with $1 million, you could earn 50% a year. But you have to be in love with the subject. But there's different people that just find it exciting to expand their knowledge in a given area.
And if the greatest investor in the world is doing it, what makes you think you don't have to? Part of that due diligence is not just the company, but the external factors that have an impact on it. If your company deals in AI chips, you need to know everything about the tensions that are going in the world with chip trade in Taiwan. If your company ships by boats, you better be prepared for when a ship blocks the Suez Canal again and takes out 80% of shipment to Europe for 2 weeks. Step 4, make informed decisions. And once you've done all of that, it's time to make some actual investment decisions. In my opinion, you should always keep a diversified portfolio. Don't just go all in on a single stock. No matter how confident you are at it, it will succeed. Many people did with Nvidia, and now it tanked 26% in just 6 weeks. You don't want to be completely dependent on a single stock doing great. Incorporate a mix of Chinese equities, bonds, and maybe even a REIT into your portfolio. The bonds have low correlation with the stock market. So even if your stocks perform poorly, you'll have a decent portfolio growth from your bonds, potentially. Your portfolio could build, rather. The equities are a bit higher risk, but they could give you a larger return if things play out according to plan. A REIT covers real estate, so it gives you exposure to a whole new market. Not all of them might start doing great literally tomorrow. You should sort of take a long haul investment horizon when investing. Warren Buffett once said, "My favorite holding time is forever." Don't invest in a company if you don't think it will be around in 50 or even 100 years from now. Keep a long haul perspective and don't assume the Chinese markets will flip the US tomorrow. It will probably happen at some point in the next decade. But trying to time the date of that is a guarantee for failure. Pick a thesis. Make your decisions according to that thesis. And then just stick to your plan the next few decades. If you do that, you have a great shot that you won't fail. So we currently have an opportunity to make once in a decade potential money in this upcoming recession. And I think that the Chinese stock market is the way to do it. At least definitely one of the big ways to do it, especially if the US is heading into a recession, which according to some indicators, it looks like it could be the direction we're all headed in. That being said, the Chinese stock market is a scary place if you don't have the right guidance and info. But fortunately, we're here for you. In our private Discord community, we share daily, weekly updates and insights into not just the Chinese stock market, but all financial markets, from the US stock market to crypto, and from gold to the Hong Kong stock market. Click the link in the description to join. Thanks for looking at our YouTube video, and I'll see you on the next one.